Hi everybody, this is Gary Wilson and welcome to this week's live investor agent training webinar. Also welcome aboard to everyone who is or has been in any of the other training programs. We just rolled out the wholesaling program. We've got a few people in that. We did property management this past fall. Let's see what was before that. I think that was the flipping was before that. And then the rental profits program was before that, if I'm not mistaken. So welcome aboard to all of you. And also welcome aboard to all the newer folks, particularly from Las Vegas. Let's see, where else? Albuquerque, Texas, California. Welcome aboard to all of you. Tonight, what we're going to do, guys, is we're going to continue into the second module, which is in most of the programs, where we talk about really analyzing invested properties. What we're going to do tonight is we're going to go over another rental calculator, another property evaluator program. It's a little bit different, excuse me, than the one we did last time. Remember last week we had Paul Ritter on. He's the credit guy. The week before that we used the opportunity evaluator and the basic cash flow worksheet. Okay. Tonight what we're going to do is we're going to use this one. It's an online version that everybody has access to. You can see the link up here, the URL. So you might want to, if you have a on your computer, if you're able to do a snapshot or a screenshot, go ahead and do that. But you should have it in your material too. This one is more of a financial calculator. I'll explain what I mean by that as we go through it. But it really is something that appeals well to, say, like financial planners or accountants or bankers, for example. Okay, the one we did the other week would appeal to everybody, actually, but more people who are maybe from a technical field, engineers, things like that, or people really who are just in the investing. This is nice, like a nice little surprise, because it is geared towards analyzing invested properties, but it provides information in a content format that is similar to the financial industry, in other words, stocks, bonds, and mutual funds. So that's why we like it so much, because it actually speaks a different language, and it helps you attract people from different walks of life. So we're going to go into some examples on this and explain things. And then the other thing we're going to do is we're going to get into the 12-step process on what you go through when you are working with investors. We're going to kind of slow down when we get to that point and take our time. Okay, and it's that process. You want to print it off. It's in all of your manuals, and you want to practice that as much as possible for a minimum of 4 weeks. In order to really, the reason is it's a behavioral skill that we're developing, not a academic skill. What we're doing tonight is considered an academic skill. I'm sorry, in the first part of the class tonight, this is academic. It's the second part is going to be more behavioral learning, okay? And you'll know what I mean by that when we get to it. So first things first, I'm going to do a quick check for questions one more time to make sure we're current. And let's see, Fassel says he spoke to Daniel. Oh, good, Daniel David, excellent, Fassel. Hopefully he was a lot of help. He's normally a very good guy. And I, by the way, appreciate you taking action and taking the lead on that. So, in any case, so I'm going to reduce my panel, guys, and let's go ahead and dig into this calculator here, all right? First things first, we're going to start with the basics, and then we'll get more advanced as we go along. I just want to allow you to become comfortable with it first. And remember, this is an online calculator, then you get the link for it in your materials, so you want to take it, the link, and save it onto your browser as a favorite. And you just bring it up, hit the enter key, and you get this calculator. So let's go ahead and let's put in some examples. Let's start with one. Let's think of a property. Let's say a $500,000 property. Okay, and we're going to start with an initial down payment of 20%. All right, which is sort of a standard, typical thing that the banks like to see. And we're going to assume an interest rate, let's say 4.5. And we know that they're inching up, but let's just say that's what it is, and we can still get that actually. Monthly rent. This is your gross rents coming in before any deductions. Okay. So let's assume this is a 5-unit building bringing in maybe $2,000, let's say $2,500 a month. So that is 12,500. Oops, that didn't turn out right. 12,500. That's gross monthly receipts. Okay. Now, as you can see, the calculator automatically calculates cap rate for us. All right. In this case, 30% cap rate. Boy, wouldn't that be awesome, huh? But we got to do a reality check here. The reality check is we haven't deducted any expenses yet. So, in any case, by the way, cap rate, just to review that briefly, again, it's in all of your material, but this came up in class the other day, and I brought up some examples directly there in the room. Cap rate is a reflection of this. You take your gross monthly receipts, okay? You deduct your basic or known expenses, taxes, insurance, and repairs. You do not deduct any debt service yet. In other words, principal and interest portions of loans are not deducted at this point. So you're taking what's called your net operating income, which is your gross rents minus taxes, insurance, repairs, those basic things, right? That resulting figure you divide by the total purchase price of the property. So in this case, you would divide your net after this gross monthly income minus your basic expenses, divide that by 500,000 and you get your cap rate. Right now, that figure is 30%. Pretty neat, okay? Because if you took this 12.5 on a monthly basis, multiplied it times 12, whatever that would come out to, is 1/3 of essentially 30% of 500,000. So that's your basic cap rate. We'll fill in the gaps here as we go along. Okay, there are some assumptions here along the way, but let's go ahead and click on the assumptions while we're in each box before we jump too far forward. Oops, that's supposed to expand that. There we go. We're going to assume. I'm going to assume a loan term of 240 months. Excuse me. We're going to assume buying costs. This is like the expense of the transaction. Let's just keep that at 1%. So if you notice, when I reduced the term from 360 to 240 in terms of months, obviously our payment's going to go up. Okay, but we're going to pay it off faster. We're going to pay this off in 20 years versus 30 years. Okay, cap rate. Now let's look at vacancy rate. Vacancy rate they've got here 8%, way too high. I mean, right now, we have properties that are 0, right? And the average has been between 2 and 3%. So let's just say it's 2.5% vacancy rate. Rent increases, you better believe they've been on the uptick for the last 10 years. But let's just say now, because we know we're technically in a shift, let's be conservative. Let's say that's 3% instead of 4%, because I'm kind of a conservative person. I would rather make a decision on a purchase based on conservative assumptions, rather than make a decision on a purchase of a property based on aggressive assumptions. And the reason is life doesn't always show up the way you think it is going to. And if your property will work with conservative assumptions, it will likely work in the real world and also possibly pleasantly surprise you, as opposed to the alternative, which is if you're aggressive on your assumptions and your assumptions don't bear fruit like you thought they would, or don't bear out to be true, you could find yourself with a far less valuable, productive property than you thought you had. So, in any case, property improvements. These are initial expenditures to get the property ready for rental. Let's just assume that's 0 for the moment. We're buying turnkey. Let's say property management is 10%. Maintenance is 1%. So 1% would be, let's just keep it there. That's fair. Insurance costs, yep, that sounds fair. Move-in, move-out costs, that's like your typical cost of turnover. Let's make that 1,000. Okay, I've been doing this for a lot of years, and that's probably a pretty safe figure on a turnover for most units. Okay, now property sales assumptions. What this is assuming is that you're actually going to sell the property eventually. In most cases, you will. And when you do, yes, you're going to have a commission to pay, and you will have some appreciation. Now, appreciation here is of 4%. Let's make that 5%. Okay. And there's a number of reasons for that. In some parts of the country, guys, appreciation is a lot higher than that. In other parts of the country, it's not that high. But 5 is a really good conservative average, excuse me. Okay? All right, so we're now going to go into box number 5, land value. I usually like to think of land value as being about 5% of the total purchase price of the property. So let's say that's 5%, which means land value is $25,000. This is going to affect depreciation and things like that. That's why this is important, okay? You don't depreciate land, you depreciate the improvement to the land, which is your actual physical structure. Okay, property tax. Boy, this varies from, man, I mean, for those of you around New York City and around there in northern New Jersey, even, you're going to have some pretty high property tax rates. In other parts of the country, they're actually quite low. So let's say that's 3%. Okay, we would be paying $15,000 a year on this $500,000 property, right? And that's probably not too far off what really happens out there. Tax rate, yeah, let's keep it at 25%. Capital gains rate, let's keep that at 15. Cost inflation rate that you apply to your increased, in other words, your cost of maintaining the property are going to increase over time just based on basic inflation. The fuel costs go up. Your laborers charge you more money. Materials cost more money. Drywall, paint, nails, and hammers, and things like that. Inflation hasn't been that great lately, but let's make that 1% actually. Your investment hurdle rate. So what this is okay, if you want to compare this investment with other investments, you've got to make an assumption here. What are those other investments likely making? Well, as you notice in the stock market, the Dow finally hit over 20,000 a few weeks back, and even the Nasdaq is up dramatically from its low post Y2K. All right, so 8%. That's probably pretty good. In other words, what that's saying is, I believe I can get 8% return on average in other investments outside of real estate, stocks, bonds, mutual funds. That's probably realistic. Probably I could do better, but let's just keep it at 8%. Okay, so far we've put in some actual figures and we made some assumptions. So let's just start back at the top and see where we are. Okay, so we have a $500,000 purchase, 20% down, which is $100,000, leaving a loan that we have to get for $400,000. Okay. 4.5% interest rate. We're going to pay it off in 20 years, i.e. 240 months. We're going to assume the cost of the transaction is 1%. We're the buyer, so we're not paying commissions and things like that typically, that is. All right, gross monthly rent's $12,500. Vacancy rate 2.5%. Rent increase is 3% annually. And you may not raise your rents every single year, although I suggest you do. That's a subject for a different day. In other words, you don't want to, I just expand on that for a second. You don't want to let your renters ride for too many years in a row without a rent increase, because they're going to get conditioned on not having rent increases. And then when you do have a rent increase, it's going to be a shocker to them. Okay. The other thing too is this: you're going to be falling behind fair market value for rents. So if you keep them up every year, number one is you keep up with the market. Number two is it's not such a shocker. Your tenants tend to expect it. And by the way, you don't have to raise it $50 or $100. You can raise your rents $18.31 and things like that. And what happens is it makes it look like it's a legitimate raise. You're not just gouging people. It's based on the cost of doing business. Okay, just a little trick there for you. Okay, moving back to the class here. We're going to assume no initial costs because we're going to assume the property's up and running. So no deferred maintenance, for example. Excuse me, property management 10%. Monthly maintenance is 1%. Insurance cost 0.5%. Moving costs $1,000 per turnover. Let's see here. All right, if we sold the property, and I think the assumption is it's a 5-year holding period, at your appreciation rate, you will be selling it for $638,000 and $638,141. Okay, we'll talk about more of that here in a minute. In any case, we are going to assume a land value 5%, property tax 3%. you're going to assume your tax rate is 25%, capital gains is 15%, cost of inflation is 1%. In other words, our cost of maintaining the property is going to be increasing by 1%, and investment hurdle rate is 8%. So let's look at some results here. Expected rate of return and cash flow summary. This is a summary. So at the end of the day, after 5 years, projected 5-year, it's called 5-year internal rate of return, is 68.2%. Return on cash invested, in other words, you put down $100,000, you're going to get a lot more than that in return. In other words, you're going to get back in 5 years all of your money plus some. And you can see right here, net total, you put down $100,000, but remember your income is based on a $500,000 property. All right, so that's why the thing about real estate is it's expected to be leveraged, and so your rate of return is much higher because your return is based on the total price of the property, not just what you put for the down payment. Okay, all right. Initially, you're in the hole $100,000, no doubt about it. We put down 20%. Year one return is $56,000, and this by the way, this is not just cash flow. This is appreciation plus the tax benefit of depreciation plus your cash flow. Year 2, year 3, year 4, year 5. Year 5 also includes the sale. That's why you see the whopping $296,000. Okay, so you had the gain on the sale, which was like where did I see the $138,141 plus your cash flow. Okay, so that's how the summary works. Let's just show you some other information here. There's other tables you can look at. All right, cash flows and return on investment details. Initially, you're in the hole $100,000. Net cash flow after 5 years is $324. The sales price, again, after 5 years, you sell it for $638,141. Your selling costs are $38,288. In other words, you've got commission in there and so forth. And you have a taxable gain of $186,217. Okay, that's your net gain when you factor in your cost basis and depreciation, recapturing, and all that kind of stuff. And if I name a term that you're not familiar with, guys, just let me know. You can actually Google it. So when I just said depreciation, you've got to recapture that. What that means is if you depreciate a property throughout the term of ownership, if you own it for 5 years, on a $500,000 property, Uncle Sam's going to let you write off just on the building itself about 3.41%. In other words, that's about 3,400 times 5 is a 15, about $17,000 you get to write off as a paper write-off, a phantom write-off. Well, when you sell that property, you've got to recapture that. What that means is you're depreciating the property, which means on paper you're deducting that $17,000 you're depreciating per year from the initial cost basis of the property, which is $500,000. So in 5 years, $17,000, that's $85,000. So when you sell the property for $638.41, you don't just pay capital gains on the difference between $500,000 and $638.141. You got to first deduct the $85,000 you took in depreciation from the $500,000, leaving you $415 as your new cost basis. There's other factors, and maybe you added a roof and things like that, so it gets added back on. But in other words, you're paying capital gains on everything you depreciated throughout the ownership of the property too. So remember, it's a double-edged sword. A lot of people think, hey, I'm getting this great write-off. Well, it's not like it's free. You're essentially borrowing money from Uncle Sam during your period of ownership. Okay, taxes. We're assuming $42,000 based on your 25% tax rate. You've got to pay off the remaining balance on the mortgage, which is $332,316. So you paid off out of $400,000. You paid off $68,000, roughly speaking. Okay, on the mortgage. So in any case, there's your figures, right? If you look at your ROI cash flow, obviously it's going to increase over the years, and you add all those up, that's your figure there. You have your, what we consider your present value. What that is, guys, is you look at the actual value of the property now, and you have to discount it by your hurdle rate. Remember that 8%? Well, that's where this comes into play. So if you net it by what you would have earned in other investments, in other words, you're ahead of the game by 287,000. All right. Your walk-away price between renting and selling, in other words, if you decide you want to sell it and you want to know what would be your price at which you would walk away from it, that number is 787,000. Okay. Um, in other words, if you can't sell it for that, you'd keep it and keep renting it out. If you can sell it for that, you take the money and run. All right. In any case, assuming a sale price is 638, cost of the sale 38,000. Your cash proceeds is 600,000 before you got to pay off your taxes and your mortgage, by the way. So you look at your depreciated basis. Remember I told you it's around 415,000? Well, there it is right there. In other words, you depreciated it at roughly 3.41% for 5 years, and that took your 500,000 cost basis down to 413. Taxable gain, you add that back in. Depreciation recapture tax, in other words, the depreciation you took, you've got to pay 25% tax on that. That's 21,591 tax. That's your tax you paid on recapturing that 85,000 depreciation. Okay. Capital gains tax is actually 20,000. So in any case, you pay off your note, and you can see the actual cash you're walking away from the closing table with after you pay off the taxes and your debt. It's 225,000. Not a bad day's work. In other words, in 5 years, you more than doubled your original $100,000. You got it back, and you added another, extra cushion there. So in any case, not a bad day's work. It's a financial calculator. I just went through it, step by step, but I know for some of you, a lot of those terms sound unfamiliar. What I can tell you is this, guys, the best way to learn it is to actually use it. So you want to save this on your browser bar as a favorite and use it and plug in examples and look and see what the calculator does for you. Okay? It's just like snow skiing. People always wonder, man, what's the best thing I can do to get ready for snow skiing? And the answer is to go skiing. You can do all the exercises you want, and they'll help, but the reality is the best thing you can do to practice for the game you want to be in is actually practice the game. Okay? In any case, let's look at a few more pieces of this before we move on. This is yearly financial projections. You can see each year what the projections are for rental income. So that's your 12.5 times 12. That's what that figure is. Interest on your loans, 18,000. Taxes is 15,000. Insurance is 2,500. So if you look back at those assumptions we made at the beginning, that's what these numbers are coming from. Okay, remember that? Insurance was 0.5%. Taxes were 3%. Interest is 4.5%. That type of thing. Tenant turnover costs. This is what happens whenever somebody leaves. You'll be out about $300, all said and done on average. Sometimes you're not out any money because literally one person moves out, the other person moves in. But sometimes you have a property, a unit vacant for a month because you've got to paint and clean and so forth. Maintenance costs. The actual buying cost, remember we said that was about 1%. That's 5,000 is 1% of 500,000. And you see it's only in the first year. You don't see this figure in the other years, okay? All right, property management. You can see it goes up over time. Rental expenses, total expenses is 60,000. So your net income is 85,000. Again, we're just looking at the first year here. Depreciation is 17,000, and your taxable income is 68,000. Not a bad day's work. So, in any case, that's your tax cost. That's your reduction in the principal on the loan. And there's your actual net cash flow, all things considered. And as you can see, it goes up each year. And you add all those up, that's your total cash flow after 5 years. So in any case, let's look at the next table. This is ROI, return on investment. So your initial down payment is $100,000, okay? Your yearly price appreciation is $25,000 in that first year, which I think is 4%. If I remember, we made that 4%. So let's see, what would that be? No, that would be more. Would that be 4%? I think it would be 4%. I can't remember. In any case, appreciation net of taxes. In other words, you got to pay taxes on that. So the difference, the net difference, is left you with $21,250. Net cash flow, therefore, is 56,000, and the net worth increased by 77,000 bucks. Okay, so because you made the wise decision to purchase this property, you just added 77,000 on paper to your net worth, and each year that increases. And you can see in the 5th year it's the greatest. You know, your rents are increasing. Most of your costs stay relatively fixed. They do go up over time gradually, but for the most part, they're relatively fixed compared to the rest of the market. So, in any case, year-end balance details. Let's look at that, and then we will open up for questions and move on to part 2 of tonight's webinar. Okay, loan balance. This is your you took a mortgage of $400,000. You can see each year that principal balance is being reduced by your payments. You can see the interest charges each year, principal reduction each year, and monthly payments, or mortgage payments, excuse me. Okay, so those are the basic, that's the rental property reporter. Let me go back here. Whoops, hang on one second. And I'm going to go back to the top, and then we're going to open it for questions before we move on to part 2 of the class. Let's go back here to questions. And we got a lot of them. Okay. No, we don't. We have 2 of them. Okay. Peter says, how do you calculate annual rent increase rationally? So good question, Peter. One of the things I used to do is, I don't read the newspaper for the sake of just having something to read. I would always get the Sunday paper and look at the real estate section and see what other people are charging for rents and just keep track of it. I mean, I did that every single Sunday. I'm going to, before church, get up and have some eggs and some coffee. And while I'm having coffee, I'm going to look and see what are people asking for rents. I would also look at other publications like your local, Green Sheet, Penny Saver, things like that. You can also, believe it or not, find rentals on your MLS. In other words, people advertising properties for rent. See what they're charging. And you want to kind of build a sort of a intuitive base for yourself of what market rents are and what are they doing. Are they going up or down? Okay. You can also call your local property management company and ask them, what are the rates for the area, and what has the trend been? What were the rates 5 years ago? What are they now? What are they projecting them to be this next year? They should tell you what they're going to rent increases are going to be. So you want to contact your local property management companies. Look at your publication, in print, and also you can look online. You can go to Craigslist. I do have to warn you, there are software programs out there. There's different websites. They give you projections on rents and rent increases. Just be forewarned, we've used them before, and they don't, I'm not saying they're wrong, that's not what I'm saying, but they don't explain things in a way that you actually fully understand how they're getting their figures, where they're getting them from, and what are they including in their surveys, and what are they excluding in their surveys. So Peter, be very leery of the online things. A lot of times they're really there to make money. They're charging advertisers to advertise on their space, that type of thing. You get the information for free. They charge other people to advertise on their space. That's how they make money. But in case, back to the main thing I want to emphasize there is they're not telling you, what they're including and what they're excluding in the surveys. So you have no idea what type of properties they're calling on. They might be calling on all the big apartment complexes and completely eliminating or excluding the mom and pop operators, people that own duplexes and triplexes and fourplexes. But again, the other point was look and see what your market is giving you just in those local publications and your local property management company. That's the best way to do that. Okay. All right. So what is the benefit of selling if the property is cash flowing? Peter, everybody has a different exit strategy. There's properties I've sold that were clearly cash flowing, but at that time, the gain I could make on the sale allowed me to do other things that for me at that time were more important than hanging on to that one individual property. So I know that's a theory, but I just want to describe to you some of the thought process and criteria that goes into a sale of an investment property. Some people have to sell under duress. they're going through divorce, they lost a job, they got transferred, they're moving, they got all these properties. Some people they're tired. They're in their 70s and 80s, and they're like, I've owned these things for 30, 40 years. I just want to get rid of them. I want to relax, we have owners well into their 80s that still have some properties, but usually in their 70s, they start to figure out how can they sell them. In any case, multiple reasons. Everybody's, there's every different story under every stone. It's not all about cash flow. Cash flow is obviously very important in rentals, but there are reasons to sell, and the reasons sometimes are greater than the benefit of keeping the cash flow, I guess is what I'm saying. So, good question, by the way. Okay, let's see here. Cash from a sale at bottom of table 1, is that plus the 100,000 down, or does that include the 100,000? Table 1. Okay, let me go to table 1, Glenn. Hang on one second. Cash bottom of table 1. Table 1. I've got to reduce the my panel here, Glenn. So hang on one second. Okay, so initially $100,000 down, purchase investment. That's your total annual cash flow first year. Initially you're minus 100,000. That's what you're out. Then you got to regain that. Okay. Well, you sit at the bottom of table 1. I'm sorry. Hang on one second. Bottom of table 1. Okay, yeah, cash from sale. So this is literally your walk away cash in your pocket, Glenn. So if you review this table, you add up, let's just go back to the top here, okay? So you have your cash flows throughout the 5 years, all right? You add all those up. You can see right there, initial $100,000 in the hole, $100,000. You got your sale price, $638. All right, so the reality is you bought the building for $500, you're selling it for $638. Conventional logic says, well, I got $138,000. That's really not necessarily true, because you didn't actually put down $500,000. You only put down $100,000. Okay, so your return is actually a lot greater than that. In any case, you got the cost of selling, your taxable gain. If you do the math, there's only 186. Taxes are 42, pay off the note leaves 332. So your cash flow ends up being 449. If you add up all your cash flows from the year and your actual cash in pocket on the sale, that's what you get there. So the bottom line is Glenn, it's what you put in your pocket. That's what this is. This isn't adding or subtracting necessarily that first $100,000. What this is saying is, when you add everything that you put into it up top here, which of course was your $100,000, okay? You add your gain, what you sold it for, which is your over and above your purchase price. You got to recapture depreciation. You add up all your cash flows. You do all that work, okay? At the end of the day, your net gain, after you paid off your taxes and your debt, the mortgage is $225,224. Okay? In other words, you put $100,000 down, you got $225,224 back. Okay, that's how that works. So in other words, this isn't really $325,224, and it's really not, 125,224. It literally is. If you follow this scenario and you put down $100,000 and you got all those cash flows and you had all those expenses, at the end of the day, this is your return. Okay, so in any case, hope that helps. Let me go back here and double check. I don't know why that does that sometime. I want to bring the panel up, and let's see what other questions we have. Okay, I may have missed this. How do we find this calculator, and does this replace the rental calculator you provided us in the investor agent program? And this is Fassel. No, Fassel, this is in the initial set of material that you got, and actually if you go to the membership section, silver level membership section, down at the bottom are all these resources. So the very first email you got from Beverly would have had this in there. She may have just pointed you to it on the website, but essentially that's where you'll find it. So, and it does not replace the Opportunity Evaluator. It's a separate tool, and some clients will be more drawn towards this one, and some clients will be more drawn towards the opportunity evaluator, which is, of course, the Excel spreadsheet. You should definitely learn both, and the best way to learn it is just to practice it, actually. So in any case, let's see here. What is my access to this tool? I would like to use it for what if scenario analysis. Joe, yeah. So Joe, if you look up top here on my screen, you'll see www.rentalpropertyreporter.com/resource center with a dash in there /investment property analyzer with a dash in between each of the three words. So you want to basically do a screenshot and grab this and save it onto your browser. It's free. This doesn't cost a dime. And I love this tool. And this is probably one of my favorites, okay? Again, it's in your material, but you can get it right here. Just do a screenshot or a snapshot or just hand write it down. I'll leave it up there for a second. Actually, let me just leave it for a second, and you guys can write that down if you need to write it down. Okay, hang on one second. Give everybody a chance to do that. And then we will jump into the next part. Okay, this is Dottie. Okay, Dottie's asking, is this similar to the cash flow worksheet? So Dottie, the cash flow worksheet is really the basic version. That's the first thing you want to learn is the cash flow worksheet. It's very simple. Your rent's coming in, your basic expenses going out, and you calculate your cash flow. The next thing you should learn is the opportunity evaluator, which is the Excel spreadsheet, and that's what we did 2 weeks ago. And then I suggest you do this one third. This one has a lot more flexibility and latitude. It gives you a lot more financial analysis. The opportunity evaluator is a great snapshot tool. In other words, you get information on the property, you plug all the figures in, you can get a real accurate current day snapshot of what you're looking at. And you can do what ifs also with that. It's a great what if tool, just like this is. At a certain point, you're going to probably be like, Glenn here, like me. I'll use this. I'll use both of them. I'll look at this thing from a number of different angles and see how many different views I can get of a property before I decide to move forward on it. Okay, excellent tool. So, okay, let me double check here and make sure. Okay, thanks. I see the URL. Didn't know if I needed a login in it. Yeah, so Joe, no login. We just bring it up just like that. Start plopping in your figures, and let it rock and roll. So, okay, I'm going to jump to the next thing, guys. Here, hang on one second. All right, and I'm going to reduce the panel so I can go through this with you, and I can see my whole screen, and then I'll open it up for more questions again. So hang on one second. Let me get you guys, get your bearings straight. Okay, so this is also in most of the training programs. More specifically, it's in the Investor Agent Training Program, although we do use it for the flipper program, the rental program, and so forth, because it's that valuable. And you want to learn to do this, number one. And number two is you want to show this to your investors and have them go through this. You basically want to condition them to follow this method here. Okay, so let's go ahead and go through it. First things first, this is literally what I used to do years ago when I would work with investors. I'm just going to walk you through. Let's assume I've already met a prospect. I did my marketing, and they responded to me. And I've had my initial conversation with them. I've qualified them. I pretty much know what they're looking for. What I'm going to do is I'm going to have them, excuse me, send an email to me recapping our conversation. Number one, so I make sure that we understood each other and there was no fuzzy areas. And number two is it's going to show commitment on their part. It's going to show that they really are committed to doing this when they send me the email back. Okay. And number three is it tells me, okay, I got everything I need: email, phone number, physical address, whatever the information I need from them I've got, and I can begin to set them up on a search. Okay. So that's my old email address from years ago. It's actually still out there. I just use it for junk now. Most of my anything I sign up for something, I use that as the email address. But in any case, all right, so you get their information, you have their criteria, and you're going to set them up on the MLS with a search. All right. Now, the very first time you run the search, it's going to be sent to them. The results will be sent to them via email. Of course, there's going to be a lot of results, because it's capturing everything at that time on the MLS. Now, you want to give them what we call the full listing, the entire. Don't just give them the email view or any other short version. Give them the full thing, the whole kit and caboodle. All right, because remember, you've got these guys under contract. That's one of the things we talk about is you want to have them under a contract to work with you. You don't have to worry about them getting information that you don't want them to have. You want them to have all the information. And the way you do that is with the full listing, okay? All right. Now, the next thing we're going to do is we're going to show them how to go through the properties and separate the wheat from the chaff. Because let's say you got 100 properties. The result was 100 properties met the criteria. Okay? You're not going to go look at 100 properties, and neither should they. You've got to narrow that number down to about half a dozen, and this is how we're going to do this. Okay? So just, if you could, go ahead and put down your pens and pencils for a second, take a deep breath, and really pretend like you're a consumer. Okay? You get this email with all the listings on, or the full listings. The first thing we're going to try to do is narrow that list down as easily and as quickly as possible. In this exercise, we're assuming the rentals. There's another version that we use. Oops, didn't mean to do that. Another version that we use for flips. Very similar, but somewhat slightly different. Okay, so they get all the listings. The first thing you do is this. Everybody has an idea, every seller has an idea of what they want to sell their property for, and every realtor, every listing agent will put that figure out there on the MLS, or they'll, through some channel, through some effort, they'll determine what their list price or asking price is for the property. Now, that's one piece of information that in and of itself is absolutely meaningless. It's just what they think they're going to get for the property, or what they would like to get. It's not what they're going to get. However, relative to other pieces of information, it is very relevant. Okay? So one of the things we want to do is determine what we would call fair market value for that type of property in that area. And it's very easy to do because you could simply do a CMA on the area and determine that. And a couple things to keep in mind, guys. Remember, we're not casting a wide net. We're not just looking at every property out there hoping to find a needle in a haystack. We're using our school report, Melissa data, Planning Commission website data to determine specific areas where we're going to be looking for our properties. So what that allows us to do is we can do some market analysis on those specific areas because we're getting very specific. Well, you need to do that because you need to be able to tell your client, hey, that type of property, that area should go for this amount of money. Well, whatever that is, okay, what you're looking for is sometimes, by the way, you get it from your county's tax assessment database. In other words, when you put a listing out there, you'll take the assessor's fair market value from your county assessment database and put that out there on the listing. In fact, a lot of agents will do that. Matter of fact, some MLS systems actually require that, believe it or not. Okay, regardless of where you get that value from, what you're going to do in this first step is compare the asking price for the property to what you believe is the fair market value for those types of properties in that area. And if that list price is higher, you're not going to look at it any further. You're literally going to discard it. Okay. Now, if it's below, if the list price is below the fair market value, you're going to keep that one in the good pile. And you're going to go look at it again in this second wave of activity. This first wave of activity, you're simply comparing list price with fair market value. Anything over it, you discard. Anything under it, you keep. That's as simple as that. So you're likely going to cut your property. Maybe you found 100 results. You're now going to be quickly down to about 50. Okay, that's phase one. Phase two is this. Okay, you're going to go back to all the ones you kept, the ones you kept in a good pile, and you're going to start to look more closely at photographs of the property, lot size, room sizes, other characteristics. This will take a couple of passes. What you're looking to do here is settle on your final list of properties that you and your client are going to look at using as much of a scientific process as you possibly can, and this is how you do it. So in other words, let's say you got 50 properties you're looking at side by side on paper, and you know that they're looking to buy a rental, and they're looking at a duplex, and you know that the most profitable form of a duplex is a duplex that has two-bedroom units in it. So what you want to do is look at all these rentals, and it could be one side has 1 bedroom, the other side has 3 bedrooms. You know, it could be an up and down kind of thing. You know, the 3 bedrooms upstairs, the 1 bedrooms downstairs. You get what I'm saying. But what you're doing is you're looking at the photos, looking at the description of the property, looking at the amenities, square footage, does it have laundry hookups, all these things, and you're going to narrow it down and cut it in half, at least in half again. The reality is you want to get it down to eventually somewhere between 10 and 15 properties. All right. So this passage, you're looking at all the pictures, looking at all the character traits of the property, separating the good from the bad, and keep the good. The next thing you do is you look at the rents for the properties. Look and see what kind of rents are the current owner generating for these properties. All right. And again, you're gonna use this information to keep the good ones and get rid of the bad ones. Okay. Now this is what Peter was asking about earlier, is very critical, because somebody needs to know what are the market rents for your area for a given type of property. Okay. And you want to be in that range. You don't want to be real below it. You don't want to be too far above it. You want to be in that range, because when you go to buy a property and you go to rent it, more people are going to be looking in that range. Okay. So very critical. This could vary widely around the country. All right. I mean, heck, I was just out in the LA area. I mean, people are paying $2,000 and $3,000 a month in rent. And there's places like, in Macon, Georgia, Dayton, Ohio, out to the outskirts of Houston, Texas, for people paying far less than that. Okay. So, in any case, actually, there's a note there. Study your area, determine using the methods I described to Peter earlier what are recent rents for the area. Okay. Also remember this, guys. Another variable is this: is your client looking to buy turnkey, which means a property that's already up and running with no deferred maintenance or little deferred maintenance, or are they looking for a rehab job where they can buy something real cheap, fix it up, raise the rents, and so forth? That you need to know that right out of the gate, and you'll do that in your interview. Okay. So in any case, now you're down to eventually 10 to 15 properties. You have to, by the way, in order to get there, one more step is your client is actually going to go do drive-bys, not you, but your client. So you narrow that list down. They do, that is, they go look at the resulting 30 properties, or maybe 25 in this example, and cut it in half again. Could be 10, could be 15 properties, but essentially, when they do their drive-bys, they're looking at the physical nature of the neighborhood of the properties, looking for good signs. Are people out walking dogs and jogging and cutting their grass and trimming shrubbery and washing their cars? It's a good sign. On the other hand, is it a ghost town, or worse yet, are the cars up on blocks, boarded up windows, things like that? Well, you don't want to be in those areas. So you're looking for neighborhoods that seem to be healthy neighborhoods, right? That's what the purpose of the drive-by is. And you narrow that list down to the final 10 or 15. And here's where the rubber meets the road, guys. So this is where you really want to pay attention. So go ahead and take a deep breath. What you're going to do is your client's going to send you their final list of properties. It could be 10, it could be 12. You just don't know until they send them to you. Okay. What you're going to do is you're going to want to set up appointments to go see the properties. But before you do, you're going to review their homework. Okay, they're going to send you their information. They're going to send you the properties that they want to list, the MLS numbers. You're going to look at them, and you're going to use the same criteria to determine, hey, do we really want to go look at all these properties, or really want to look at truly the best of the best? And what you do is you rank them, 1, 2, 3, 4, 5, all the way up to number 12, for example. And you're only going to want to look at, on average, the top 6. It might be 5, it might be 7, but on average it's about 6, okay? And you have to make appointments to see all 6 of those properties, and you got to do it quickly. But the point is sometimes you have to create an A list and a B list. The A list has what you believe are the best of the best based on your client's homework, and the B list are the ones that, if you don't have such a good day, you have a B list to fall back on. In any case, you schedule your appointment, okay? And after you go through the properties, Again, this is a behavioral skill I'm going to describe here to you. All right, you're looking at your properties. The clients they're taking notes as they walk through the properties. They're filling out information sheets and analysis sheets on the properties. All right, you've already done a preview of the financial analysis. You've already done that. Now you're looking at the physical analysis of the property. At the end of the day, let's say you look at 6 properties. Not all 6 of them are going to be up to snuff. You might be down to, say, 3. Okay? And of those 3 properties, you're going to have your clients review their numbers on their own. Now, by the way, this is all happening, this conversation is occurring at the last property, or maybe you go to a coffee shop if you went afterwards. But don't ever do this. Don't ever say, hey, it was a great day, we saw some good properties, you let me know which one you want to move on. Don't do that. What you do is you want to sit with them, go through their sheets that they have with them, their analysis sheets, because they just taken some notes on the properties. They've already got the financial analysis. And you're going to have them separate one more time the good ones from the bad ones. And they may all be good. In fact, it's actually happened. But the point is here's the process you go through. It's kind of cathartic. You can either have like the summary sheet, all the properties on one sheet, or you might have individual sheets. You lay them out on a table side by side. And there's 2 processes, 2 ways you can do this. Way number 1 is this. You just literally take the first property, compare the next one to it, and ask the client, of these 2 properties, if these are the only 2 properties in the world, which one would you absolutely have to have? You keep that one and you get rid of the other one. You can and then go through all the other properties, and you keep comparing till the end of the day. You're down to 1, maybe 2, maybe 3 properties that they can't decide because they all look great. The point is you want to get it to between 1 and 3 properties, okay? And you throw away the rest, all right? Now, of those 1 and 3, here's what you do. Whether it's 1 or 2 or 3 doesn't matter at this point. You're going to tell them, all right, go home, review your numbers, make sure you're clear on your numbers. We're going to get on the phone at 9 o'clock, and I want you to scan and email to me your final analysis on these 3 properties. You're going to get them on the phone, go through and determine, do you make 1 offer, 2 offers, or 3 offers, and you literally write those offers up as soon as the phone hangs up. You guys, you do it that night. You email them to your client, have them print them off and sign them, or if you're using Dotloop, you can do that too, and send back to you a proof of funds, the actual signed contract, and photocopy of an earnest money or hand money check, okay? Now you got bona fide legitimate offers that are based on a process that allow you to focus on the best of the best. So you're not making dozens of offers. You're only making 1 or 2 or 3, only on the best properties that have the highest probability of returning a profit for your client, which means you make commissions. Okay? So in any case, you get those offers back, you send them in, leave a message for the other realtor, let them know when they get in the morning, they got 3 offers sitting on their table, or it could be 3 different agents, or it could be 1 agent with 1 offer. You get the point here, okay? The other good news about this process is what it results in is you're not making these ridiculous low offers either. Typically, your offers are on average somewhere between 10 and 20 to 25% off list price, all right? It's a wonderful way to go about doing business with your clients. You can imagine this will take a few iterations to get it down to a science, but when you do, now you and your clients are basically operating under the same guidelines, singing from the same song sheet, so to speak, and the success rate is higher. In other words, our average acceptance rate on these is 65%. Through negotiating, you got to negotiate the offers, of course, but on average acceptance rate is 65% by using this process. Okay, let me take the deep breath, and I'm going to reduce my panel back over and look for questions. Okay, let's see what we got here. Hang on 1 second. Let me go back to where we last left off. Oh wait, Peter had a question from the old that calculator. Hang on 1 second. Peter's asking, what is the rationale behind walkaway price? Oh, so Peter, what that really means is, okay, if you're in a position where you could sell the property or you could not sell the property, in other words, you could live with it, you could live without it, at what number would it make sense for you to sell it? And that's the walkaway price. In other words, if you get that number, you sell the property. If you don't, you walk away. You know, you get what I'm saying. That's your keep the property versus sell the property number. That's what that walkaway price is. Okay, let's see, Monty. I keep losing you. Oh, hopefully you're okay, Monty. Sometimes it's the internet. Everybody else seems to be okay, but let's hope you're okay. Let me know if you're still okay. All right, step number 7. Should I be reviewing the client's financial calculations on those properties as well? And so I have them. Yeah, oh yeah. So who's that, Roger? Yeah, Roger. You want them to scan the email on those final like 3 properties. You want everything. You want the physical analysis, the financial analysis, because you're now going to be playing the role of advisor, as guide, consultant, and 2 eyes are better than 1. Now remember, you're not making a decision for them. You're simply looking for things that perhaps they missed or different interpretations. Okay, you're basically, just like masterminding. Henry Ford and Harvey Firestone. 2 heads are better than 1, and wherever 2 minds come together, you actually create a 3rd mind. So in any case, good question. Okay, Jackie, do you have a qualifying question sample sheet? Really what I do, Jackie, is when I'm working with a prospect, it's usually because they responded to one of my marketing campaigns, like a booklet or a letter or a workshop or any of the other 20-some-odd marketing campaigns. So they've kind of pre-qualified themselves. I know they've got motivation and sincere interest. Timing's usually pretty good, that type of thing. So what I like to do is whatever marketing they responded to, Jackie, I'm going to have that on. I'm going to refer to that. So if it's a workshop, I will have met them in person, obviously. If it's a letter or a booklet, I'm going to have in front of me what they responded to, and I'll use that to build rapport. In other words, the letter says something like, inventory is tight. Well, let's talk about inventory. How many people rent in your area? How many on a percentage basis? How many owners? That type of thing. So you've got a great, basically, you established a beachhead with your marketing that allows you to more easily establish rapport. So, Jackie, you're really just having a conversation. And what I'm trying to determine in my first conversation with these folks is, do they seem to be more interested in rentals, or do they seem to be more interested in flips, or wholesaling, whatever the case may be? And when I get to that point, when they tell me, so Jackie, here's the clincher. You're going through looking at, you should be, if you're really want to take this to the next level, when you're on a call with them, what you can do is say, look, let's jump online. Okay, you can do a Skype call and let them see your screen and show them a couple properties, right? Now, at some point, no matter how you're doing this, Jackie, they're going to say something like, what do we do now, or what's next? Then you qualify them for the suitability to be able to move forward. And here's 3 really critical questions, Jackie, that you need to ask. There's others, but at a minimum, these 3. Number 1 is, what do you have in savings? You want to know their cash position. Second one is, what is your credit score? So if they have to get a loan, which most people do, you know that they can qualify. And the third one is, do you have an available line of credit? And the reason that's important is if they have a line of credit that has availability on it, that means they can stroke a check quickly to type a property and make an offer. Okay, that's really, really important. So those 3 questions, Jackie, you definitely got to ask those. Cash, what do they have in cash? What the credit score is, and do they have an available line of credit? Good question. Okay, Peter, right, but how is that determined? Oh, the walkaway price, Peter, that's actually, that calculator does it for you. Yeah, that rental property reporter, that does that for you. Okay, it's based on all the numbers you gave it and all the assumptions you made. So that number can vary depending on your assumptions and whatever variables you put in. So I apologize. Yeah, that's done for you. Okay, Monty says I'm okay. Okay, good. Thanks, Monty. All right, I had to watch the recording of last week's webinar. Where do I get the Excel spreadsheet from? So, Glenn, that is in your initial material. When you go on to the membership section, if you go down past all the recorded webinars at the bottom, you'll see resources and you'll see the opportunity evaluator down there. But I think Beverly directs you to it directly in the very first email. Okay, let's see. Monty, what kind of contract do you sign with client in order to share full listings? So Monty, we always use a buyer's agency agreement, and good question. So when I was just responding to Jackie in that initial interview, what you want to do at the end of the interview is this. If you it really, and don't call it an interview. Just tell it's a conversation, right? To you, it's an interview. To them, it's a conversation. If you got through the qualifying part and you sense your conversation is coming to a close, here's what I want you to do. You want to say this. You can write this down, guys. Actually, I teach this in the class too. This is you speaking to them. In this case, let's say Monty, it's you. I'll say, Monty, would you please email me with a recap of our conversation? Okay. Now, when they email you back, what you're getting is valuable information from their perspective that helps you serve them. And also, it shows you by their behavior that they're willing to commit. Small commitments lead to big commitments. It shows that they're willing to engage with you, and it shows that they're willing to take action. So, Monty, when you have that, that's when you send them your buyer's agency agreement, and you get them to sign it, and then you start working with them. Okay, Deb says, explain the walkaway again. So the walkaway price is this. Maybe people find you, they find out you've got a good property, they send you information, hey, I'd like to buy your property. All right, there's a price where it would make sense for you to sell it, okay, versus keep it. And below that price, if you don't get any offer below that price, well, you don't sell it, you keep it because it's cash flowing. However, if you get an offer on your property that's at that price or higher, what that walkaway price is saying is, economically speaking, or in whatever your personal circumstances are, maybe you're getting transferred, what have you, that price is good enough for you to say, I'm willing to give up the cash flow on that property because the money I'm going to get on the sale is more important to me than the money I would get from additional cash flows. That's all it is. That's all the walkaway price is. You can walk away from the property if you get the number you want, and if you don't get the number you want, you keep it. That's what that walkaway price is. So, okay, Glenn says, thanks. You're welcome, Glenn. Siri says, Gary, I'm working on neighborhoods by zip codes. Which one should I research more into? Well, Siri, what's going to happen is certain neighborhoods are going to be more renter-oriented, and certain neighborhoods will be more owner-occupied oriented. And the school report is more useful for flippers, which means you want to look on neighborhoods that are more owner-occupied. And by the way, people who rent single-family homes, they're interested in the school area information too. So some of your clients will like to buy single-family homes and rent. So the answer is, certain neighborhoods are going to be more renter-oriented, and others will be more flipper-oriented. You just need to know what those are, and you can use school report and Melissa data to determine that. And then in the zip codes, and in Melissa data, by the way, so when you look at the carrier routes within the zip codes on Melissa data, the carrier routes, they have an average home price that fall within the price range that you determine on your school report. Those are those specific neighborhoods within those zip codes. Okay. Excellent questions, guys. It's 10 after 8, so Eastern time, so we're going to wrap this one up. I look forward to meeting with you all next week, which will be right now, actually Tuesday again. Next Tuesday, 4 p.m. California, 7 p.m. Eastern, 5 p.m. Mountain, and 6 p.m. Central. And we will go into some flipping information next week, okay? And as always, if you have specific subjects you want to discuss, please let me know. Also, please remember to review anything that Beverly sends you. Anytime Beverly sends you something, it's important. Particularly if you're a new student, because if you look at you should always keep the initial email she sends you, because it has an orientation webinar you've got to watch, and all the instructions you follow to make the most of the program, and it basically answers a lot of questions. Also, the weekly emails that go out after, like tomorrow, you'll get one with a recording of tonight. Definitely review that, because she gives you information in there too. So in case, I appreciate you guys. I will look for you all next week, and particularly those of you in New York, I get to see some of you in person in New Jersey. That's pretty awesome. All right, God bless you. I hope you enjoy the rest of the week. Bye-bye.